Hello, I'm Deborah Trowell, the founder of Elevation Wealth Partners, and this is the Elevation Market Update. I am pleased today to be speaking with Kevin Lewis of American Century Investments. Kevin's been working with them for 29 years, and he is the Vice President and Senior Client Portfolio Manager and a member of the Global Growth Equity Group. He's based in Kansas City, home of the Super Bowl champions, of course. So welcome, Kevin, and tell us, are you a fan?
Deborah, yes, good morning to you and to all your clients. I'm a large Kansas City Chiefs fan, so it's been a fantastic time to be here in Kansas City.
And yes, great time to be a fan. So you work with large companies, and we know that when an investor goes to Morningstar, they have a wide array of funds that they could choose for their portfolio. So tell me a little bit about your approach and what maybe makes that different from other companies.
Sure. First, there's really three things that we believe differentiate us and our approach to large cap growth investing. First, it starts with a team. It always starts with people first. Our team is one dedicated to the portfolios that we manage. Why do we say that? That's because it enables us to escalate and elevate issues, and there's always issues in the market, good or bad, so that we have the resources around us on our 10-person team to elevate and address those issues. Secondly, what's unique about our team approach is we have collective decision making. So in this world, frequently you'll see a star portfolio manager. That might be right for others, but what we think works best for us is we use collective decision making. And in that regard, we believe that the wisdom of the group is better than a single interaction between one analyst and one portfolio manager. So we believe we get better outcomes in our thinking when the 10-person team is debating and deciding on how to allocate capital in the portfolio. And thirdly, on the team, I'd highlight is a great degree of industry practitioner experience that forms our team. What do I mean by that? One of my colleagues is a former drug research scientist with Bristol Myers Squibb. As we are going to meet with companies, we are meeting not only with the senior level executives, but for instance, the chief scientific officer at that pharmaceutical company. And my colleague, Michael, is ideally equipped with his background to be talking former drug research scientists to drug research scientists to look at those compounds in the pipeline that may come to market, and not all of them will, but those that have a high probability of coming to market and driving the growth down the road. Two other quick elements about things that differentiate us. We invest in competitively advantaged businesses capable of sustained high growth. We are looking over the next 5 to 10 years. Many people in the market are looking at the next quarter, maybe even the next year, but we are assessing the capability of these companies over the next 5 to 10 years. You see, what we're doing is looking at the compounding of fundamentals. It's that compounding of fundamentals that we believe will have a positive impact on the stock price. And thirdly, and lastly, we construct our portfolios around our research. What I mean by that is we don't make large sector tilts or bets because we don't have a sector timing model. We don't time cash. We simply construct the portfolio to be different, Deborah, in terms of our stock weighting decisions. And those three are what differentiate us from many others in the field.
Sounds great that you have so much expertise to be able to really talk on the level with any particular company that you're talking to. So underlying all of that, what kind of philosophy is guiding you?
And that's very important. As a former member of the military, I look at this as our compass in the market. In other words, go this direction, don't go that direction. There's really four parts of our good business philosophy. And let me start there. Before we think about a stock, we want to say, is this a good business? And that good business starts with a competitive advantage. That competitive advantage could be from the management team, the business model that they have that's rather unique, or the products or services they're offering. And what we like to look for is a competitive advantage that then leads to higher profitability than that of their peers. We think that's a sign that they're doing something better or different. Thirdly, with those profits that they have in the bank at the end of the year, we'd like to see that there's opportunities to grow the business, move into new geographies, do product line extensions. And with that growth, you typically get better scale of the business. What do I mean by that? Basically, the business becomes more and more profitable. And if I could just take a moment to illustrate one company that we've had in the portfolio for a long period of time, it's Costco. And this is by no means a solicitation to go out and buy Costco stock. It's simply an example, an illustration of how we think about Costco. Its competitive advantage, we think, is with the management team, their high quality merchandising. But think about Costco's business model. It's a model where you pay to shop there. And not many retailers like Walmart or Target have that, but you actually pay to shop there. And its profitability, that next leg, they have higher profitability in our analysis than that of their closest competitor, Sam's Club, or even Walmart or Target, in terms of their sales per square foot. It's with that profitability, they continue to expand their store locations. They're expanding in Asia, they're expanding in places like Canada, and that gives them more scale. Where they're buying in larger volume of tires or shirts or what have you, that gives them economics of the business that become stronger and stronger. So, Deborah, that illustrates first and foremost, we're looking for a good business that starts with a competitive advantage and leads to a profitability or a path to a higher profitability with growth opportunities in scale of the business. And that's what wraps up our focus of what we're trying to achieve in the business. And we try to buy the stock at the right time.
And besides that, I'm sure you're also looking to buy the stock at the right price. We all want to get a good deal on anything that we buy. So how do you go about determining that?
Yes. So I just mentioned that it's one thing to identify a good business. The stock becomes an attractive buy for us when there's good valuation, meaning that the stock price offers sufficient upside to us in our estimation of the potential appreciation potential. And to do that, we use the same methodology that you would frequently use to value a piece of real estate, maybe the building that you're in right now. We are looking at the cash flows from the business. And if it was a building, you would look at the rents coming off of that business, but we're looking at the cash flows from that business. We determine those cash flows, our estimate of the future of those cash flows, by meeting with the company management and assessing their growth plans, their size of the market, and challenges from competition. Then we construct a forward-looking financial model. And from that, we can see the potential profits off that business that we can then value those profits or cash flows in what's called, in financial terms, a discounted cash flow model. It basically means, Deborah, that we are looking at the stream of profits over the next 5 to 10 years, discounting those to assess what is the value of that business worth today. And we're looking for a gap between the value of that business today and what the stock price is in the market. If there's a good appreciation potential, then we will then debate that and see if other risks make it a good portfolio inclusion candidate.
And you made a key point as well, that it's not looking at what's happening today, but those 5 years down the road to see, will this still be a good company to be holding? And so you also talked about that you have this team of 10 people. So you have 10 people, 10 lots of research and opinions. How do you bring all of that together and not end up in a gridlock?
Yeah, it's a very appropriate question. I'll start with a quote I've seen attributed to Steve Jobs, that great things in business are never done by one person, they're done by a team. And so we certainly believe that, as I mentioned before, the wisdom of our team leads to a better outcome. And what we do if a stock is pitched to our team and we then would decide and debate that, is if there's issues that are causing concern among the team members, what we'll frequently do is we'll go talk to the company, and those people who have a concern, they'll be on the call. We strive to do that with the analyst who's pitching the idea, and we'll try to address those by meeting again with management if we can, or seeing if these concerns are so large whether they just derail the stock altogether. But we are constantly trying to push an idea to a point where it's either we're going to proceed with more data and get to a proceed to, or we're going to vote on it, or is it just not strong enough to be included to the portfolio? But gridlock is something we avoid by having senior leadership on the team trying to shepherd that conversation forward. And also when there is gridlock, by making sure we get more information, more data, Deborah's. And that's how we try to push through, not to take shortcuts in this business, but trying to make sure that we don't wait an inordinate long time to get to a conclusion.
Yeah, timing is important as well. And so we hear a lot of talk in the news about interest rates and inflation. How much does that figure into your work?
Yes, so we don't impose on the portfolio a view on interest rates or inflation or things like that. That's called market timing, and that can be very challenging and very difficult, because the markets will move on both fundamentals and psychology around those. So we don't do that. What we do is we invest in these competitively advantaged companies, and, as we are meeting with them and assessing them, we are frequently meeting with the management teams who've demonstrated a great capability to navigate challenges, whether those be macro or what's going on in the economy, or whether those be competitive, things like that. So we are trusting a great deal on the management teams of these, again, very capable, competitively advantaged businesses to navigate those challenges that may come up. And we'll ask them, like, how are you dealing with inflation? How is the consumer in your eyes? What are you doing about that? The other thing is that when we are looking at these companies who are capable of sustained above average growth, in our opinion, we frequently will see underpinnings of that growth driven by what we call secular trends. And what I mean by that is these long lasting shifts that are going on every day when we wake up and go to bed at night. These shifts continue going on in the economy or in business. And what do I mean by that, Deborah? I mean things like the aging populations of countries around the globe. You see, countries in many parts of the world are having a large proportion of their population turn age 65 and older. That means more demand for healthcare and more allocation of their budgets to healthcare. And also, Deborah, one other trend that we've been seeing is that companies across the globe, but particularly in the US, I'm referencing, are spending more of their budgets on technology than they were in prior history. That's because they want to be competitive on a global basis. They want their workforces to be more productive. They can do more with the same resources, compete globally. So again, while we don't impose a top-down, a interest rate view or an inflation view on the portfolio, we really leave that up to the companies. And of course, we're following up with them. But then again, we still see many secular trends or long-term trends, Deborah, that are going on each and every day as we wake up and then go to bed at night, that are helping to underpin the growth of the companies that we're invested in.
Yeah, and it's interesting to see how these changes in our population are driving, of course, what happens with the companies that serve us in our lives. And you mentioned technology here. Of course, in the type of large company fund that you work with, technology features heavily. And the buzzwords now, of course, everyone is talking about AI, artificial intelligence. So what do you have to say about that right now?
Yeah, well, it's been really interesting that companies have advanced in their ability to first capturing data on their businesses. That's been sort of the first leg of this process in terms of artificial intelligence. Now, with that large data sets, they have the computing capability to train and evaluate that data. That's where the computer is looking at all that data and saying, in simplistic terms, what's going on? What, I see in this situation that this occurs. Back in my former programming days, I like to think of this as a if-then statement. If this is going on, then this might happen. So that's sort of where we are largely now, that companies are pointing and training on the data. And the next leg that we're now starting to see a shift to is what we call inference. Excuse me, inference. That's where we can make better informed decisions from that data set. And some examples of that might be in placing advertisements. We've seen an example of a large oil company using this training and analysis on its energy data sets. They may have a lot of data on oil fields and all the information on that. So how can we make better informed decisions on what to do next with all this data on their oil fields? And I've also heard, Deborah, that there's a fast food restaurant that's making its drive-through more robust by enabling a chat bot or a capability for that ordering drive-through to be enabled for multiple languages. So you could imagine driving up to a fast food restaurant and speaking different dialects, and the information being able to be processed and read back to you in multiple dialects, and it just expands the capabilities there. So a lot of really interesting next steps for that capability. And what these do, Deborah, is really make businesses more productive, more efficient, more intelligent. And that's where we're starting to see that next leg of this AI revolution take place.
Yeah, that would be very cool to be in another country and be able to order your food and actually know what you're going to get.
Yes,
Be able
exactly.
to interact.
Right.
Yeah. Yeah. So I know that your world doesn't just look at companies in the United States. You have a larger global view. So what sort of interesting opportunities are when we're looking outside of the US?
Yeah, so we are first and foremost U.S. large cap growth investors, and that's what we are hired to do, and we keep our focus there. However, we do allow a budget in our portfolio of up to 10% to invest overseas. Why do we do that? When do we do that? We will do that when we find an exceptional company overseas that isn't available in the US. And sometimes we see that in just a company with maybe in biotechnology, or the ability to create semiconductor chip production, something like that. You have some companies that are really global. They may be located internationally in another country, but they're really a global business with a unique capability because they've got a large proportion of market share. So, and we can't find that exact equivalent in the US. So it all starts and stops with, is it a competitively advantaged business capable of sustained above average growth, an excellent business that has room to grow? And if that business happens to be located internationally or overseas, again, we only limit 10% or less. It's a very moderate degree today. Then we will proceed with investing in that company.
So thank you for all this great information so far, Kevin. We're getting towards the end of our time together today. Do you have some closing thoughts for us?
Sure, Deborah. First, I'd like to thank you for the opportunity to speak with you today. It's been a pleasure to share our thoughts. I think when you think about American Century, we are a privately owned company in Kansas City. A large part of our profits go back to serving humanity through the Stowers Institute of Medical Research. And, as we are investing the portfolios, we have a very focused mindset on trying to find those companies that are capable of sustained above average growth. These are quality businesses that undergo rigorous fundamental research. And so I just appreciate the time to share with you how we think about that. And as always, it's been a good business partnership.
Well, thank you, Kevin. And I know that our investors will be very interested in this deep dive today into the large company growth world. Most anyone who has an investment portfolio is going to have some kind of investment in this space. So great to get all this information. For our viewers, if you have questions, please feel free to reach out to us at Elevation Wealth Partners, give us a call, an email. And otherwise, we'll close out for today and look forward to our next time together. And we'll have a very special guest, Cara Murphy, of the Chief Investment Officer of Kestra Financial. Thank you.